Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita and with me is Aisha Faridi. Let's quickly look at what's playing out on the Nifty 50 index. And in that sense, we're around 0.5% higher on the Nifty. So we're perked up fairly well. Those initial blips, if I can call it, that edgy little start to the day has actually now seen a much more stable index. 0.5% higher, 25,200 is what we're hopefully gunning for in trade today. So that's obviously the key positive. Let's look at how some of the other indices in terms of sectors are doing. And even in terms of the breadth on the Nifty 50, it's a fairly solid breadth that we're seeing across the board. 40 plus stocks sitting in the green. So a fairly solid index composition in terms of the gainers versus losers on the Nifty 50. HCL Tech, JSW Steel, Tata Steel, SBI Life leading the pack. And within that as well, Tata Steel, JSW Steel, and some of the commodity and metal names doing very well for themselves. 2% plus higher on both of those names. So a fairly strong day where metal stocks are concerned. Stocks sitting in the decline. Tata Motors, second straight day where we're seeing red on Tata Motors after that JLR release that came out. Axis Bank is the other one, 1% plus lower on an Axis Bank as well. But outside of that, Maruti, Titan, HDFC Bank also not having the best of outings in trade today. So that's, of course, on the Nifty. Anything that's standing out for you, Kunal, with regard to where the Nifty 50... Firstly, good afternoon. Let me welcome you on board. Anything that's standing out for you where the Nifty 50 is concerned today, Kunal?
So large caps again are making a comeback. I think today it's a differentiated set of large cap names. Today it's not the usual HDFC Bank and ICICI Bank which are making a comeback, but you have a different set altogether. The likes of BSC, Lupin, pharma stocks are showing signs of strength. So I think that's where the markets could probably get some bit of a positive Q on. FMCG index is also seeing a good recovery, and this comes as a very positive surprise for the markets or the sector front as such, because we were at a point of a breakdown of sorts on the FMCG index. But with this recovery, this also puts in place that the markets are into a very stable trajectory. And broadly, when you look at the index, we are still trading in a band of 25,000, 25,200. But then I think if we can manage to absorb the kind of negativity which was there in the index yesterday, the opening downtake and then the intraday correction for the index, I think this is a very good repair work or the recovery for the index. Net, the breakout point for the Nifty is still at 25,000 to 25 thereabouts on the spot levels. My belief is that hopefully in the next 1 or 2 days, we should see that breakout happening on the spot levels Nifty. And whenever that happens, I think we could now be looking at 25,500 as the next set of targets for the index. So stance still remains on the bullish side.
And Kunal, do you still believe 25,500 can be achieved in the next day or so, because we're approaching Friday? Or do you think that's a bit of a test?
I mean, if it happens one day after also, it's okay. But sure. I think the mood of the market still indicates that the recovery path for the index is still on the upside. And I would be happy if it achieves, say, by tomorrow. That's my expectation. But even if it happens in the next couple of days, that should be fine.
Okay, the clear leader today is the Nifty Metal Pack. Let's pull up the Nifty Metal Index. What a phenomenal move. 1.8% higher on the Nifty Metal today. Of course, you have a Tata Steel, JSW Steel fully supportive of that move. But we're clocking new highs nearly every other day where the Nifty Metal Index is concerned. 10,300 breached and taken out by the Nifty Metal Index. The top gainers there, Hindustan Copper. There's also Lloyd's Metal, which is doing very well. Hindustan Zinc is doing very well. NMDC, well, this one has been a standout for the last few days and continues to stand out today as well, up nearly 3% on the back of all of the gains it's already clocked. So NMDC is surely in focus. And then there's, of course, the two large caps, which weigh heavy on the Nifty Metal on either side of the move that it makes. There's also Nalco. This one also has been in focus, 2% move. I remember Nalco was one of the picks that Kunal had, and we had another couple of technical analysts yesterday who had Nalco on their radar. I'll be curious to know whether that up move and that momentum can sustain, and 235 still could be a good target when Nalco is concerned. Kunal, you think so?
Yeah, very much, Harsh. And I think today it's a classic synchronized move for the entire metal/commodity space. And I think looking at Nalco, the breakout on NMDC, Tata Steel, I think the stock sitting at a multi-month high. SAIL 6% up. Vedanta heading towards a breakout. And so I think when you look at this kind of a context from the entire metal slash commodity theme, I think it's a brilliant setup for the entire sector. And I also get a sense that even though the dollar index is at 99, I sense that we are looking at a near-term top or a resistance point for the dollar index. And I think that's what the markets are probably anticipating heading towards a breakout for the Nifty Metal Index. So if that happens, if the reversal happens on the dollar index, you might probably expect another propelling move for the entire metal sector.
You know, Kunal, they say copper is the new gold. And clearly Hindustan Copper seems to be reflecting the way in which gold is moving. Talk to us about that one. 5% higher today, and it just continues to breach its highs.
Sixth consecutive week of price uptrend for Hindustan Copper, and I think for 220, in just no matter of time, the stock has jumped back to 350 plus levels. So there are two stocks in the same breath. Of course, copper is one, silver is the other commodity, and Hindustan Copper and Hindustan Zinc. I think both of these stocks, which do get influenced by both of these base commodities, I think both of these stocks are looking very strong on the charts. Now we are looking at a point where these commodities are already into a multi-month, multi-quarter rally for themselves. So which means that eventually or gradually, even the stocks would probably head into the further breakout level. So bullish on the stocks. Whether you're looking to buy the entire quantity at current levels, that could be a bit of a trade. But I think sizing the positions on dips could be a good strategy.
Okay. Kunal, the other piece that'll obviously play out between today and tomorrow is TCS and IT in particular. We've had a very good move on IT, another near percent higher on the Nifty IT index today. TCS up 0.7. Let's pull up some of the big names in IT, and Infosys and HCL Tech, Tech Mahindra, Wipro, LTI, Mindtree. Let's pull all of those up and try and see what the moves seem to suggest. 0.5% higher on Infosys as well. HCL Tech is doing surprisingly well. 2.5% higher on an HCL Tech. Then some of the mid-cap names, Persistent is up 1.4. Wipro is doing well as well, 0.8 odd percent. LTI, Mindtree also similar breadth, and so is Tech Mahindra. So pretty much in a decent kind of a move where IT is concerned. What's your take, Kunal? Sustainability of this, because a lot of this will also depend on fundamental factors. But give us the sense, what's it looking like on charts? Would you trade it at this point or would you avoid?
See, of course, you avoid as a technical trade, especially pre the big event on the results. But then I think you have to give credit to the IT index in the last 4-5 days. I remember, I think we were at a point where we ended the September series and the expiry at a point when the Nifty IT index was one of the worst performers on a sectoral front relative to the top key sectors, the FMCGs, the real estate, even though these sectors were massive underperformers, but IT index was one of the key underperformers. But then in the last 4-5 days or start of this October series, we are now looking at IT index at least recovering and now coming maybe 5th last or 6th last in terms of the price performance. Again, relative scorecard performance for the IT index. That tells you the kind of recovery which you've seen for large cap IT stocks and mid cap IT names. Assumingly, if post results, you don't see any major disappointment, then you could probably expect a slew of short covering which could combine into many of these IT names. So I think it's always prudent to try and wait out for the results or the events to go by. Even if these stocks say jump up by another couple of percentage points, assuming post results, that would still be a good trade or a entry point for betting into the IT space.
Okay, and talking about IT, it's just absolutely accurate to get a take with regard to what to expect from TCS, because they'll be reporting Q2 earnings today. Of course, no press conference to be held today. Mansi is here with what to expect from TCS.
We are expecting a muted quarter for the IT sector in particular. And if we talk about the IT major TCS, the expectations for TCS too are muted for that matter. However, it is expected to post revenue growth of 2.5% on a quarter-on-quarter basis. And if you talk about the international business, that will see a growth of around 1% is what our expectations say. And at the same time, if we consider the segment-specific approaches for the company, we are assuming the BSNL to ramp up around in the third quarter in particular, and the performance of the BSNL ramping up in third quarter. And also we expect the margins to stay intact at 25%. So that's one thing which should be intact. We do see a 2.5% upsurge in the revenue growth And if we talk about the dollar revenue, around 0.5% of increase in the dollar revenue is what is expected. Talking about the profits, it might see a dent of around 1.4%. That's a downtrend of around 1.4%. Profit might see a decline due to the 1 month impact of the wage hikes which were seen, the talent investments, the lower utilization and constrained leverages. So these are the concerns and factors because of which the profit might see a downtrend. And at the same time, if we talk about the productivity in particular, the pyramid and productivity gains remain key levers, but pricing pressure, client behavior and the Gen AI transaction signals which we have seen, it's a start of realignment for that matter as vendors adapt pricing and delivery models. So technology it is, and technology has to keep changing, and as they say, change is inevitable. So clearly the pyramid and productivity gains remain the key levers as we see. The key monitorables this time for the results are outlook on near-term demand and tech budgets, at the same time outlook on BFSI vertical and the deal win scenarios. So all in all, it might be a muted quarter with a revenue growth witnessing an uptick of around 2.5%. The dollar revenue might see an uptick of around 0.5%, and at the same time, the profit might see a friction of around 1.5%. So that's the expectation for TCS.
Well, thank you so much for that, Mansi. And, we'll have a slew of views coming in on TCS in particular and IT as a whole over the coming week. But let's listen in on the IT sector from Shishovan Nayak of Anand Rathi Institutional Equities. He's given us a view. What we'll also do is dive into a quick break. On the other side, we'll have Ajay Bagga. We'll discuss IT a little bit more. Listen in.
We are actually positive on the large caps. Our top picks would be Infosys, LTI Mindtree, and HCL Tech within the large cap space. While in the mid caps, we believe that we just have to look at the valuations and the growth corresponding to those valuations. For us, we'll be a little more selective as far as the mid cap IT space is concerned. Of the H1B visa, that companies may resort to things like offshoring, which will possibly reduce your billing rate for some time. But what it will possibly help is in improving the margins as such. And with the share of wallet increasing, we'll possibly see the absolute EBITDA or the absolute cash flows increasing, which we believe this will be something like a hockey stick phenomenon, where for some time there will be some amount of revenue deflation. But with increase in share of wallet, we'll see an improvement in margins and profitability, and the absolute EBITDA also increasing.
Welcome back. You're watching Closing Trades here on ET Now, and with us, joining us at this hour is Ajay Bagga, market expert. Great speaking to you as always, Mr. Bagga. This is Harsh here. So let me start off by asking you IT, because that's what we were discussing just before we went on break. You have a great grip of the global macro setup, and IT largely depends on that. You see a rebound in IT at some point in FY26. Is that something which is realistic? Because that will likely come out in the commentary tomorrow. So trying to get your sense on what you're penciling in.
Yeah, definitely. I think the worst of IT earnings are behind us, and things should improve going ahead. There is some amount of lack of visibility for the Indian IT services companies because they have been slow in terms of the AI end-use offtake. I think that is what will ratchet up. If you see the last 3 quarters of earnings commentaries, a lot of the workforce is being trained on using AI, and a lot of end-use caselets are being created to help companies benefit from the massive investments in AI that are happening globally. What has happened is the results have been underwhelming. There was an MIT research out last month, which showed that about 95% of companies are reporting no increase in revenues after implementing some AI solution. Same way, McKinsey came out with a research that about 8 out of 10 companies have not seen the benefits coming in right now. I think as the AI matures, you're going to see more end users coming in, and that's where things get exciting for our IT services companies. So definitely, I think the worst is behind us, and you would see a recovery next year. There is a strong correlation, as you mentioned, with the global macro. We are expecting a better growth than this year. The whole world is in an easing cycle. A monetary easing cycle is the predominant theme around the world. And next year, that benefit will also flow through in the macro. And as the macro improves, you will see more order flows for our IT services companies.
And if I were to shift focus maybe away from IT, talk broader market as well, how do you view current valuations and how do you kind of rationalize that with the global setup as well? We've got some of the markets which have done extremely well over the last 12 months or so, while India has been absolutely flat or likely more negative than flat. So how do you rationalize that? Do you believe earnings will likely drive the re-rating going forward? And if so, how quickly does it come?
Yep. I think three, four things going for us finally. One is the income tax cut, which is slowly adding more consumption power into the taxpayers' pockets. The GST cut has had a consumption impact. We will get to see the numbers by October and we'll get a better idea of that. But definitely from the street checks, consumption has taken off post the GST cuts. That's helping. The liquidity infused by RBI and the 100 basis point rate cut, that has helped a lot. And then inflation being in a very comfortable zone, that has helped as well, along with the huge expenditure that the government has continued on infrastructure. So last year, this time around from March to September, we lost out on the momentum in infrastructure spends. By December, it started catching up. And over the last 6 to 9 months, we have seen a lot of injection of infrastructure spends coming in. Now, the festive season, we should see that benefit coming in. The government has announced a DA increase of 3%. That given the massive base of the government servants, that translates into a huge consumption stimulus that goes right into the consumer economy. So a lot of things going for us. 13 months have been underperformance, sheer underperformance. MSCI EM index has done very well. Last 12 months have been an emerging market outperformance, along with continued US exceptionalism. US markets have continued to do well, with the heavy lifting being done by the AI plays. But overall, we've had a rare occurrence where emerging markets did well and US did well, and India didn't do well. India, which is largely correlated to the US markets, we tend to rise and tend to fall with the US markets. That historical correlation got broken. So 13 months of negative returns, that is setting us up very nicely for 12 months, which should be much better. The trigger will be twofold. Any relief on the US tariff front, that will be a sentiment booster. I think that's not a direct economy booster, but except in certain labor-intensive sectors where it will save some jobs or see jobs coming back. So one is anything on the US tariff fronts, and second is the earnings returning. We were expecting that June would have been the bottom of the earnings cycle, but the GST announcement coming on August 15th and the implementation coming on 22nd September, that has meant that 40 days of discretionary spend got hit. Now, there is a catch-up that has happened from 22nd September onwards, but there could be some flow-through into October for it. So the September earnings might still be muted, might be on par with June or slightly better than June, but the real kicker will come with the December earnings. So market will not watch the September earnings so closely as the management guidance. Management guidance on what the management is seeing for the next quarter, for the next 12 months, that will really determine. And you will have very outlandish moves on good results, good guidances, and anything that is below expectation will get hit quite badly. So markets are not very optimistic. That's a very good thing. Markets are still very short, especially in the FPIs and the HNI prop books. Those are still quite short. So that's a good thing. So if there is a surprise on the upside, that should be much more than any surprise on the downside. But you don't have space to stumble because of the valuation. So valuations are much better. than they were 13 months back, but still on a global scale, they are higher. So again, if you cut out some of the old economy segments and then look at valuations, there are segments which look attractive. But right now, on a passive investment, ETF flows, country fund flows, we are not getting our fair share. And that will only change either sentimentally with US tariffs or fundamentally with some amount of guidance coming in. Markets will recover before the earnings recover. That is a given. So about 3 months before the earnings start showing an upward trajectory, markets would have started rallying. And you will get a 5-6 months move in 2 weeks or maybe less than that. That is the big thing. So positioning has to be positive is what I would say.
Thank you so much, Ajay, for summing that up. You know what we'll do? We'll slip into a very short break. On the other side, we'll continue this very interesting discussion that's playing out with regard to when do markets recover, because broadly, Kunal seems to be penciling in 25,500 in the next 2 days. You want to watch out for that. But stay with us. More on the other side of this short break. Welcome back. And among all the buzzers that are playing out in markets, we have a Satwik Green, new listing, Q1 numbers, and we spoke with Prashant Mathur, the Chief Executive Officer at Satwik Green Energy, and he shared that the company will be debt-free very, very soon. Let's go across listening to what else they are expecting ahead.
We are also foraying into inverter business. We have already EPC business. How we are building Satwik is as integrated manufacturer as well a player in the energy space, especially the renewable energy space. Both of these orders will be executed in this financial year. Our debt, long-term debt, will be completely paid off, which is about 175 crores. So we will be, in terms of debt long-term, will be debt-free.
Well, bullish commentary. They have a 4 gigawatt order book, which they plan to execute over the next 12 months. So looking green, Satwik Green. Just one piece that maybe you want to keep in mind is that the cash flow to EBITDA conversion isn't exactly playing out. So apologies, EBITDA to cash flow conversion isn't really playing out. So you want to wait and watch out for that piece to also start to play out. But the other big buzzer, Snehi, in trade, and by the way, Snehi also joining in, Snehi Shah. Snehi, the other big buzzer in trade was a Prestige Estates.
Oh, yes.
4.5% higher, blockbuster numbers for Q2. You want to take us through the numbers first,
sure.
And then maybe we take a view.
Sure. Blockbuster is the word to sum it up, Harsh, and very good set of numbers coming in from Prestige for Q2. So if you take a look at what these numbers look like, very healthy move coming in terms of their pre-sales, their collections, their realization that has also managed to inch up. So all of that looked very good. In fact, it was a beat coming in on all three of these major metrics for a real estate company. So beat on all three of these fronts. And what really stands out for Prestige and what has done very well today and is helping the stock to be up more than 4% is the fact that their first half sales in FY26, the first half itself has already overtaken the full year sales of last year for Prestige. So FY25 full has already been overtaken and surpassed in the first half itself. So that is something that has worked out very well for Prestige. And you actually have very bullish notes coming in from brokerages, wherein Nomura also maintains the company to beat the guidance that they had given between 25 and 27,000 crores of pre-sales. Nomura expects them to do about 29,000 crores this year. So that is also something that sounds optimistic. Nomura has maintained a buy rating, target price of 1900. Same target price coming in from Morgan Stanley, but they maintain overweight. For Citi, target price at 1910, they maintain a buy rating. Interesting to watch out from Nuvama, because they've maintained a buy rating but cut the target price to 1,966 from 2009 earlier. So significant cut coming in to their target price, but nonetheless they continue to maintain a buy rating. And office segment, retail segment, occupancy, exit rentals, they all look very healthy. So that's the take on Prestige. Kunal, we've been talking about the real estate sector for the last 2-3 days now. Some renewed optimism once again in this entire space. Would Prestige be one of your top picks?
It may not be one of the top picks, but I think today's move indicates that the stock is getting ready for a breakout. Now, it's not the price, which is very attractive for Prestige in terms of the percentage up move, but it's the volumes. I think today on the cash side, the volumes are one of the highest the stock has seen in the last, I think, 5 or 6 months, or maybe more than that on the daily charts. And that generally indicates that we are looking at a potential strong up move which could come by into the stock prices. And we've seen time and again that when prices go into a corrective phase, once the volume starts to pick up, that's where the confidence starts to breed in for investors to chip into the stock. And so I think on the back of this, I would expect that gradually Prestige would start to look attractive. The breakout point which I would wait out for, something which I mentioned in the morning also, that will be closer to 1625, 1650 range for Prestige. Today also, I think it tried to just about enter into that trading range, but failed to cross over that breakout point of 1625. So I would wait out for that confirmation. But yeah, I think the volumes are giving us the first indication that maybe we are looking at a major bottom being formed for the stock at current levels.
And what about other realty? And okay, before I ask Kunal for a view, Ajay, let me come to you. With regard to real estate, a couple of those numbers have been extremely impressive for Q2 FY26. Now, I know you don't talk specific stocks, but just give us a sense where you see the tilt with regard to real estate go, because some pricing concerns coming in, but really not visible on the numbers which some of these real estate companies are disclosing.
Yeah, absolutely. And again, you have to cut the Indian market in various segments. So that top end of the segment, I would say roughly about 5 to 7 crore people are doing very well. And in that K-shape, they are the ones really running the real estate. Take the macro tailwinds that have come in. RBI has dropped the risk parameters, the risk weightages that's enabled banks to lend more. Secondly, and also pass on some benefits to borrowers. The 1% rate cut by RBI, liquidity injection, all has helped both the developers' balance sheets, the developers' cash flows, as well as the home loan borrowers P&L. So overall, a lot of tailwinds working on a macro sense. You might say there is some stress in certain segments. You have not seen urban demand pick up. That's more on the staples and the lower end of the discretionary. On real estate, there's actually not any slowdown. The developer you were mentioning, FY 2025 numbers have been met in the first 6 months itself. So that's the kind of growth that one of the developers is showing. But across the segment, we are still very much in the middle of the cycle. On a 12, 13-year cycle, we are probably in the fourth, fifth year. And a lot of runway still, Harsh, for growth. So I would say real estate will benefit. You have a minor benefit also coming in with lower cement costs, lower building material costs. But that's 1 or 2%, not very material, but it all helps. What is helping is the macro tailwinds in the economy. And overall, people seeing the affordability due to the EMIs going down, allowing people to premiumize in their home loans as well. All that is helping the real estate segment.
Okay, Ajay, appreciate that view, and thanks so much for your time today. And on that note, we'll let you go. Viewers, let's move on. Once again, get in a technical view coming in from Kunal. And Kunal, any stock-specific recommendations, any BTST ideas for our viewers today?
Yeah, a couple of them, and so I'll focus on one of the stocks which I recommended in the morning, BSC. That stock is doing fairly well for itself, so would recommend a buy even at current levels. The targets I would revise it higher to 24.25 for BSC now that the stock has scaled past about the initial estimates which I had assigned closer to 2300 levels. So 24.25 could be a fresh target for the stock. Traders who are looking at a fresh buy could keep the stop losses or trail the stop losses towards 2260. NMDC is the other stock which confirms a breakout today, especially with the breakout point about that 77.5, 78 levels, which has been a huge resistance point for NMDC on the short term. So would look out for a target closer to 84 and stop loss could be kept at 75.
Okay, so that's the take coming in from Kunal. NMDC and BSE looking good on the technical front. On that note, we'll slip into a short break and talk more about the markets India. Back to closing trades. You're catching us live from the SBI Live studio. Before we move ahead, want to draw our attention to the bottom of the screen where we have breaking flashes coming in. We understand from Reuters that the UK government has announced a £350 million defence deal with India. Big news coming in, and the UK government contract is set to deliver UK manufactured lightweight multi-role missiles to the Indian Army. So that's the first word that we're getting about this deal, and we'll keep updating you with more as and when we get. But I just want to take a look at some of these missile specific stocks. Let's take a look at HCL, Bharat Dynamics, and I expect to see a sharp rise in some of these names. In fact, let's pull up a Bharat Dynamics and see what that stock is doing, because last I checked, there was a little bit of a spike. HCL up 0.7%. Want to see Bharat Dynamics? Yes, there has been a spike over there, a 1.2% uptick coming in on this stock. Some other defense stocks, let's see what BEL is up to, and some more defense names like Mascot Dock, shipbuilding. I doubt much will be happening since this is a missile deal. At least that's the prima facie word that we're getting. But still, yes, Mascot Dock also up 2%, a sharp spike on this front. So overall, very positive for the defense sector. And in fact, you know, earlier in the day, the leaders of both the countries involved in this deal, India and UK, so you had Prime Minister Narendra Modi and the UK PM Keir Starmer. They had an interaction in Mumbai today. Let's go across and listen into what both parties had to say.
भारत और यूके के बीच टेक्नोलॉजी पार्टनरशिप में अपार संभावनाएं हैं। हम यूके की इंडस्ट्रियल एक्सपर्टाइज R&D को भारत के टैलेंट और स्केल के साथ जोड़ने पर काम कर रहे हैं। दोनों देशों की युवा पीढ़ी को इनोवेशन इस ब्रिज से जोड़ने के लिए हमने कनेक्टिविटी और इनोवेशन सेंटर, ज्वाइंट AI रिसर्च सेंटर जैसे कई कदम उठाए हैं। हमने क्रिटिकल मिनरल्स पर सहयोग के लिए एक इंडस्ट्री गिल्ड और सप्लाई चेन ऑब्जर्वेटरी की स्थापना का निर्णय लिया है। रक्षा और सुरक्षा से लेकर एजुकेशन और इनोवेशन तक भारत और यूके के रिश्तों में नए आयाम घड़े जा रहे हैं। आज प्रधानमंत्री स्टारमर के साथ शिक्षा क्षेत्र का अब तक का सबसे बड़ा और प्रभावशाली प्रतिनिधिमंडल आया है। यह बहुत खुशी की बात है कि अब यूके की 9 यूनिवर्सिटीज भारत में कैंपस खोलने जा रही हैं।
We're creating a new modern partnership focused on the future and on winning the opportunities that it offers, and we're doing it together. And that's why we struck the UK-India Comprehensive Economic and Trade Agreement in July, a breakthrough moment, years in the making. I expect that we will have secured major new investments, creating thousands of high-skilled jobs in the sectors of the future for both of our nations. The UK and India stand side by side as global leaders in tech and innovation.
Okay, so some of those defense stocks obviously in focus. A Dynamatic Tech is up 12% in trade. Let's pull that one up. Let's pull up an Usha Martin as well, 7% higher on an Usha Martin on the back of all that's being announced there. Partnership between the UK and India. Kunal, any picks within the defense pack which are your favorites at this point?
So I think Usha Martin is something which I do track very closely. In fact, over the last few months, the stock has been showing excellent price trend. I remember, I think in 2024, the stock made a high which was around the 440, 450 mark. And from there, the stock went to a correction, came back to its sub 300 levels. And now it's managed to make a comeback. So it's almost like a V-shaped recovery or a U-shaped recovery for the stock. And that's excellent chart patterns, because when you look at a 1 year downtrend of almost 30% being absorbed in the subsequent next few months of the price recovery, that tells you that there's a lot of eagerness from buyers to enter into the stock price. And I think in that sense, bigger trends open up on the monthly as well as on the quarterly charts for such stocks. So bullish on Usha Martin from a medium to long term play.
Okay, sounding optimistic on that front, and that's the case with a lot of defense stocks that have just seen a recent spike in the last couple of minutes on the back of this India-UK £350 million defense deal. But on that note, we'll slip into a short break and be right back on the other side. Back with closing trades, and let's bring you a stock from the top buzzing sector, that's Nifty Metal. The entire metal space is doing very well today, but one such stock in focus today is Tata Steel. About a 3% uptick coming in on the stock on the back of robust Q2, and this has happened on the back of domestic deliveries and better production. Ashesha, my colleague, is joining us with more on this. Ashesha.
Well, yes, the entire metal sector, as you mentioned, is buzzing in trade today, but Tata Steel in particular on the back of the operational updates that the company reported for the quarter gone by, and both for India operations as well as for its overseas operations, it is reported a steady set. In fact, as far as India operations are concerned, domestic deliveries saw a growth of about 20% on a sequential basis and 7% on a year-on-year basis in an otherwise weak quarter. Now remember, second quarter is a seasonally weak quarter on account of rains, but despite that, it has reported steady growth as far as its India operations is concerned. In fact, they say improved production and stable demand across market segments aided production and sales in the quarter gone by. Now, as far as production is concerned, that too was on the higher side, and this was because Jamshedpur plant operations normalized in the quarter gone by. So production is up 8% YOY and about 7% on a sequential basis. So that's as far as India operations is concerned, but let's also talk about Netherlands and UK, and that has also reported steady numbers in the quarter gone by. So Netherlands delivered marginally higher update on a sequential and on a year-on-year basis, and as far as their Port Talbot plant is concerned, management said that construction of EAF project has begun in the second quarter. So steady set of numbers that the company has reported, but yes, the entire sector is buzzing in trade today, and Tata Steel in sync with that is up nearly 3 to 3.5% as we speak.
Shesha, thanks so much for taking us through that. So that's the update coming in on Tata Steel, and now that's your Q2 update for the market. But we also have Mayuresh Joshi, Head of Equity at MarketSmith India, joining us. Mayuresh, hi, good afternoon. Good to be chatting with you once again. And Ashesha, my colleague, was just flagging off the kind of moves that we've seen in the overall metal index today. A move so strong, in fact, for the last couple of days, if you could call it that, to the extent that it has overtaken Nifty Auto on a year-to-date basis now. Mayuresh, your view on metal and how sustainable this rally is that we're seeing?
Very good afternoon. No, I think the entire onus probably still lays in terms of how China probably comes back very, very strongly, because they are one of the largest producers as well as consumers of not just ferrous, which is steel, but also the non-ferrous metals as well. Obviously, the expectations in terms of global demand slowly and steadily coming back is something to be checked and seen over the next few quarters. But with Trump tariffs kicking in, the entire expectation in terms of how this will play out is something that needs to be monitored as well. In the Indian context, the demand probably remains strong. Government capex expected to continue at a good pace. Private capex seeing signs of coming back. You've already seen signs of backward integration happening for most steel companies. And as they ramp up these operations on the backward integrated part, there will be more cost efficiencies that will start kicking in. So the large part of expectations is global demand slowly and steadily coming back, domestic demand remaining strong, and therefore with inventory levels remaining at absolutely abysmal levels across the globe. As restocking starts taking place slowly and steadily, LME prices should also start reflecting better traction going forward, which will then create operating leverage on the balance sheets. So again, I think JSW Steel, where the EBITDA per ton might actually improve in a calibrated way and reasonably strong. Steel Authority of India, which is a large presence specifically for the domestic sector within the ferrous names, look strong. The rating and ranking suggests that if earnings probably persist, there can be further momentum that can probably come through these stocks as far as the ferrous pack is concerned. Within the non-ferrous plays, Hindalco, and obviously the recovery in terms of Novelis as well as the core operations with expectations of aluminium recovery is something to be monitored as well. Outside the core metals, I think heavily lignite, NLC India is something that we continue liking. The rating, ranking, institution holding, all the parameters that we see in CanSlip probably get fulfilled. And the targets that they probably set, both in terms of their mining operations as far as lignite is concerned, expectations of renewable as well as thermal exponentially increasing, and margins actually expanding multifold over the next 3 to 4 years, makes it a good case outside the core names. So selective, but I think there can be reasonable amount of recovery as far as the domestic names are concerned.
Okay. Some big movers in trade, and before we go to that, Reliance Consumer today relaunched the iconic personal care brand Velvet. Jude caught up with the director T. Krishnakumar to discuss the revival of legendary vintage brands and their future growth roadmap.
Actually, we are taking a bit of a shot which is not very normal in the consumer space. We are going for most of our products to be relevant to every Indian. We target, because of our pricing with the people, the bottom 80 crore Indians, but we believe our products are good enough for every Indian. Right. So that is going to be our target. We will enter into every category in consumer space. Like we have launched this for women, you can expect something for men, you can expect something for babies. So we will straddle the entire personal care business. From babies to men and women. Right. So I think that's the thought process in every category. We get into a category, then we expand to fill the category. Like we got into beverages, everybody kept on talking about only carbonated soft drinks, but now we have water, we have a sports drink, we have energy, we're going to soon put vitamin drinks. So we will, our idea is to proliferate, because we come from the background of retail. Right. So we don't like doing only one product.
Absolutely. One last question before I let you go. RCPL has been on a bit of a drive so far. Brands like Sil, Camper Cola, Velvet, of course. Vintage brands, legacy brands making a comeback thanks to, investments by the company itself. But you said something very interesting a little while ago, that older brands, legacy brands need to stay relevant today, and that will be the key determinant of how well they do in the market as it finds itself in today. How do you feel that you can bring the key differentiator towards making this relevance happen?
See, first and foremost, I think all the drive, everything is really the vision of my chairman. I mean, he keeps himself relevant every day. I mean, he knows the latest development in artificial intelligence to what the consumer wants. See, I feel the biggest strength that we have built for us, before we launched RCPL as a company, we built our own R&D facility. Right. Very few companies do that. Companies get in, and then once they get to 5-6 years, then they build an R&D facility. Because my chairman's vision is always to be on top of technology, on top of ingredients before you do anything. Right. Because that's when you can really be able to do the right thing in the marketplace. So our R&D is one of the state-of-the-art R&Ds. I would claim it is one of the best in the country. And they are capable of keeping on tap with all the developments in the world. See, relevance is keeping tab of the trends and ensuring that you keep intervening and making the trends happen. So we are well positioned in terms of back-end R&D. And, Reliance is a deep tech company. On the other side, we get technology which our chairman concentrates on. And these are two important ingredients of being relevant.
Okay, that's the word coming in from the management of Reliance Consumer, revival of a heritage Tamil Nadu brand, Velvet. But that has been the pattern in which Reliance Consumer operates, and they are focusing on revival of old brands, bringing back nostalgia, and that is the kind of user segment that they're targeting. But let's welcome on board Mr. Dharmesh Shah, Head of Technical at ICICI Direct. And Dharmesh, hi, good afternoon. Thanks for your time today. Let's talk about two of these stocks that have been buzzing and have been making the news for quite some time now, and that's Eternal and Swiggy. And the reason I ask you about both of these stocks is that today we have a Citi note coming in on both of these stocks. First was Zomato. They've maintained their buy rating, but there's been a sharp target price to 395 from 320 earlier. Similarly, for Swiggy, Dharmesh, they have hiked their target price to 495 from 465 earlier. What targets are you penciling in for both of them, and which one do you think would outperform in the near term?
Thank you, and for inviting me on your show. And definitely, I think so. The way that things are panning out for most of these new age companies, I think so. They seems to be really outperforming even in this current corrective phase. Even if you look, I think so, for like Paytms or Zomato or Swiggy, I think so. Most of the stocks have been outperforming in terms of performance. Yes, definitely. We believe, I think so the way the setup seems to be forming on higher top, higher, I think so.
Dharmesh, apologies for interjecting, but we have you on a very patchy line, so let's quickly fix that. Mahesh, would you have a view with regard to some of these new age tech platform companies? Do you like any of them, and especially with regard to an Eternal? Firstly, hi, it's been a while since we spoke, but give us your sense.
Harsh, I think pleasure to see you here at ET now. So two things. One, I think in terms of the food delivery platforms, whether it's Eternal or Swiggy, I think the expectation as the festive season begins, we've already seen the first 9 days of Navaratri where consumer discretionary spending has gone up exponentially as we are doing our channel checks. And therefore, as festivities continue in real earnest with Diwali coming in over the next few weeks, more festivities to follow. Both food delivery as well as quick commerce are expected to grow at a decent pace. Obviously, the hike in platform fees is something that might aid and assist the overall numbers as well. The opening of dark stores, which has obviously got accelerated for all the players, whether it's Eternal, whether it's Swiggy, whether it's Zepto in the unlisted space, and the competition itself. I think very few players will probably now start coming in, though we are hearing news of Jio and Amazon probably doing a few pilots, DMart doing a few pilots as well. But I think a nationwide presence is something that both these players probably have up their sleeve in terms of both cost as well as pricing advantage, along with logistics support that they probably get. Having said that, I think the entire expectation in terms of better numbers probably getting gestated in, with better numbers expected to come through in Q3 as well. Further momentum in the stock cannot be ruled out. However, I think two things. One, from a Marcus India perspective, it's way above pivot levels as we see, and therefore a little bit stretched from an aggressive entry point at this juncture. And the second element, obviously, valuations. So valuations are sky high. Swiggy, tad bit lesser compared to Eternal on a peer-to-peer comparison, but valuations still comparatively remain relatively higher as we speak. So I think anybody who's holding the stock can probably ride the momentum. Fresh investments probably still into it.
Okay, and Mayuresh, just to follow up on that, between the two, given the kind of run-up that Eternal has already seen and Swiggy on the flip side has been more of a steady move, which one do you still prefer if you had to pick between the two?
So I think Eternal is a stronger play. I think Swiggy's numbers obviously have still got to come through. And whether they show a sustained recovery, and the management probably hints with the expansion and the competition intensity that they're facing, at what point of time do they break even over the next 2-3 quarters, is something to be monitored with progress in numbers coming through. Obviously, Swiggy's valuation, as I said, a little bit cheaper compared to where Eternal is. But I think Eternal's growth dynamics might be a tad bit better compared to Swiggy.
Okay, so sounding good, and the preference is still lying towards Eternal. So let's see how many quarters it takes Swiggy to try and break even on all fronts. They have been guiding that Q3 FY26, and that was slightly pushed. So let's see what happens on that front. But you know, while we're talking about earnings, all eyes are on GM Breweries today, and the earnings have not only been good, they have been stellar to an extent where the stock is up about 20% as we speak. Let's start by talking about their revenue. Revenue has come in at 180 crores compared to 149 crores, up about 21% on a year-on-year basis. EBITDA also healthy at 44.8 crore thereabouts, up 63% year-on-year. What really stands out is the net profit number, which is up 60% on a year-on-year basis at 35 crores, and margin expansion also looking very healthy at 24.8% compared to just 18.5% on a year-on-year basis. So very healthy move coming in. And let's just pull up the stock of GM Breweries, because almost a 20% move, and also want to see a slightly longer term chart, let's say 1 month, 3 month for GM Breweries, because the kind of run up we've seen today, of course on the back of these earnings, but also want to see what the stock has been doing. Last 6 months itself, the stock is up 40%. Kunal, your view on GM Breweries, and even without triggers like earnings, do you think this move is sustainable for something like GM Breweries?
May not be sustainable, because we've seen that such kind of a strong 20% up move generally gets sold into. But this could be a more developing move for the stock to build into or start of a trend. Now, you know, this 20% move has brought the stock back into October 2024 levels for the stock, which means almost 11 months of underperformance for the stock from 900 to, at one point the stock was almost on the verge of breaking substantially below the 600 mark. So that 300 pointer correction for GM Breweries, that gets corrected or negated as such. So that, I believe, is a much more bigger positive for the stock after such a kind of a strong price uptick move. eventually we've seen that stock prices generally get some bit of mean reversion mode after such a kind of a strong up move, but then that becomes a very good opportunity for traders who are looking to buy and build into the stock from a portfolio perspective.
All right, Kunal, your view with regard to PG Electro, that one has also perked up 7% in trade. Very strong move today. Just trying to understand volume led and what are technical indicators reflecting on that one.
So again, a stock which has been all over the place, frankly, Harsh, over the last 3-6 months. I remember, I think tracking this stock when it come into the FNO around 775 or 800 levels, and from there it had dropped down to as much as 500. So I think the volatility for the stock price has increased substantially since the entrance into the FNO category. But then I think at current levels, I don't see any major kind of a turnaround. Maybe this could be yet another up move into the stock price. In the last, I think 3-4 months, we've seen similar kind of an up move for a stock, but then that generally gets fizzled into. So no major breakouts on the stock price as of now. Would suggest an avoid.
Okay, so avoid coming in on PG Electroplast, at least on the technicals from Kunal. But it's very interesting. We are going to be interacting with the management of PG Electroplast tomorrow at 9:45 on the market. So and first trade. So you might want to tune in for that interaction. Lots to talk about with the management in terms of copper prices, if they're planning to pass on the costs, what's happening with the entire AC segment, festive demand, GST cuts. So much to talk about. It's going to be a very interesting interaction. But let's move away from that. And the center is planning to set up a new federal agency for India's transport sector. It is likely to be named the Gati Shakti Transport Planning and Research Organization. And my colleague Samir Dikshit is here with more details on what this entire setup could be. Samir.
The government is planning to soon set up an apex federal agency for India's transport sector, and its name likely could be GSTPRO, Gati Shakti Transport Planning and Research Organization. As the name suggests, the primary purpose of this organization is going to provide the much needed planning, a better planning for the transport sector, and also provide valuable research and inputs so that the projects can be framed and it can be executed in a much better way. This GSTPRO is going to be a central agency which will have a participation from the key transport ministry, whether it be railways, highways, shipping and the other transport ministry, and also it will have a representation from the technical institutions like IIT and even the research organization as well. The primary purpose of this apex body is to remove the silos which are there in the transport ministry. As of now, the transport ministry, they take up the individual project, and in major of the cases it has been found that there are a couple of challenges. When it comes to resolve those challenges, it usually takes a lengthier span of time. But with a central agency, and that will have representation from all the transport ministry and the research and much needed inputs, government understand that these silos will be eliminated, and this will help to lead to a better planning of the project. And this will also come up with our long-term vision and roadmap for the transport sector, for example, for the next 10 or 15 years. And this particular model will be based on the successful transport model which are there in the developed countries like China, Japan and even Korea. So based on this line, government is planning to set up a central or the apex federal agency that will be housed under the central secretariat and is likely to be led by a senior secretary rank officer.
Okay, thank you so much for that. But one set of stocks which are surely in focus today are the pharma names. Let's pull up the Nifty Pharma Index. That one's doing fairly well. Of course, not as much zing as the metal index, but 1% higher on pharma is not bad at all. And this is, of course, one of the reasons for that is Lupin. It's a stock in focus, announced a new state-of-the-art pharma manufacturing plant in the US. And this would not only boost its portfolio, but also help navigate the tariffs which the US has been levying. Srishti is here with all of the details on this one.
Indeed, very positive news flow coming in on Lupin, because at this time and juncture where there's so much of uncertainty around tariff, but Donald Trump has also indicated that all these companies might get benefit who will come and manufacture in US, and Lupin has actually gone ahead and made an announcement to invest over $250 million in the next 5 years. And interesting to note that this is going to be for one of their key segments, that is inhalation, because
because from that segment, Lupin drives majority of its contribution in the overall revenue, and along with that, they have also said that they will be producing 25 critical respiratory medicines, including higher margin product like albuterol inhaler. Lupin will receive the tax credit and incentives from the state of Florida as well. So a very timely announcement coming in from Lupin, and second, it's for the inhalation product, which is indeed a high margin product for Lupin. So very positive news flow coming in for Lupin, where Citi as well has come out with a note on this one, where they say that the safe and a timely move. Respiratory is an important segment for the company overall. Having an additional capacity in the US will actually de-risk its complex inhalation portfolio. Why this will also help to smoothly navigate the geopolitical risk. They prefer Lupin within the whole generic space of India, continue maintaining their buy rating with the target price of 2,260 rupees. So all eyes on Lupin.
Absolutely, Shrishti. Thanks for that. All eyes are on Lupin. A healthy 2.5% uptick coming in, slightly off the day's high, but nothing too concerning. On the flip side, let's talk about a stock that's in deep pressure today. About a 4.5% cut is something that we're seeing on Senco Gold on the back of softer than expected Q2 update, wherein the revenue growth they're seeing is up 6.5%, much lesser than the high teens growth that the street was penciling in. The same-store sales growth, it continues to be pretty in line with what the street is estimating. But amid all of this, Suvankar Sen, the MD and CEO of Senco Gold and Diamonds, he has maintained the FY26 growth guidance of 18 to 20%, and he's also said that the company is planning to add 18 to 20 stores in FY26. Let's listen in to what his forward-looking guidance is for the company.
Q2, growth of 6.5%. is something that I think we need not worry about, because our Q1 growth was 30%, and what we have always forecasted and has been projecting is that the overall annual growth should be 18 to 20%. So even if you just look at H1 as the half yearly numbers, then the growth is around 16%, and Q3, which is the most important quarter for the jewelry industry, is just started, and things are looking positive. The plan for the whole year is 18 to 20%, 18 to 20 number of stores that we want to add for the whole year, and we have already added about 12 stores as we speak, and there are 3-4 stores in the pipeline. So we are very confident that by the end of whole year we will be able to add 18 to 20 stores, and our focus continues to remain on opening franchisees, looking at the tier 2, 3, 4 towns and cities, and playing to our strength of the company. We will try to focus opening more stores in the eastern, northern, and the central part of the country.
Okay, Kunal, what's the take on a Senco?
So I think nothing major on the charts, frankly, Harsh. It's a stock which has been dragging lower since the last many weeks and months. I think the high for the stock in 2024 was almost at 750, and it's still trading at a number which is 50% of the highs from 2024. Even in the last, I think, 6 months from the Feb-March lows, the stock has not done much. So it means the stock is going through a major time-wise as well as a price-wise correction. Would wait out for this entire cycle to get completed before traders venture into a contra buy into the stock price. As of now, avoid.
What's made an up move, Kunal, is a Vedanta, 2.5% higher, and now this is obviously to a certain extent also on the back of the debt repayment, or rather the release of pledged shares by Union Bank of India this morning, and that was announced this morning. 2.5% higher now, right towards the fag end of the day. We're at the day's high where Vedanta is concerned. Interesting.
It's a very interesting chart, Harsh. In fact, this makes a potential comeback of sorts for Vedanta, because the prices are almost at a 10-month or 11-month high. I think breaking past about the November highs for Vedanta. So that, I believe, is a very good breakout potential zone. Coming to a point where even the Nifty Metal Index has been showing signs of strength. You've already seen the likes of Tata Steel, JSW Steel, etc., making breakouts for themselves. So it just adds on to the flavor that the sector is going all guns blazing, and within that, I think an underperformer stock like Vedanta is also trying to make a comeback. I would actually believe that now the stock should be good for a breakout further from current levels, assuming the Nifty Metal rally continues for some more time, we could be looking at even a potential 500 to 520 for Vedanta.
I'm just going to keep churning stocks, Kunal. One big mover is NetWeb. Now 10% lower, no real fundamental trigger on the stock. But talk to us about what you're seeing on technicals, because not looking pretty at all, days low.
So I think, the stock had seen a fantastic uptrend over the last few weeks and months. If I'm not wrong, I think the rally started off from 2,000, 2,500 odd for NetWeb somewhere, I think, in July, August. And, the stock almost doubled in a matter of 1.5, 2 months or so. So maybe some bit of a profit booking happening there, the churn and the money rotating back into the other sectors, which are now looking very attractive since the market has opened up. So I think it's just a routine correction. I don't read too much into it as of now. Maybe there could be one more leg on the downside. You might see the stock heading towards, say, 3,500, 3,700 range. But that actually could be a good contra-buying territory for NetWeb.
And, restaurant brands is the other one. And, Kunal, some of these QSR stocks, right? You've got festive season coming in. I'm not sure how the numbers will pan out, but I'm hoping that that will at least give lend some bit of positivity with regard to at least the commentary. Give us a sense of how you're viewing these stocks, because they've been through a prolonged period of consolidation. Now, whether I pull out a Jubilant FoodWorks, whether I'm talking about restaurant brands or any of the others, that's where some bit of consolidation has played out. Could this be the rotational trade is what I'm trying to judge?
Not really. In fact, I would actually believe that there could be still an underperforming sector. Now you look at Sapphire Foods, you look at Devyani International, look at Jubilant Food, and so on and so forth. For most of the stocks within this space, you look at the last 4-5 weeks of price correction, the last 1 year of price trends, it's been just about sluggish to downtrending for the entire sector. So I believe that itself tells you and sums up the entire story, that the markets are looking at this space with an expectation that this drag or this downtrend will continue for the entire sector. So no point going contra over here, because we've seen time and again that when sectors go into a corrective mode, there is a point where sectors go into weeks and months of price correction before you see any major recovery into the stock price. So it's always better to buy when there is confirmation rather than just wait out in the hope of anticipation.
Okay, and how does Aurobindo look, Kunal? 4% higher. I know we've spoken about pharma. I know you like DVs, but let's throw in an Aurobindo, try and get a sense.
So I think initial signs that the stock is trying to form a bottom over here at this 15,000, 50,000, 1,100 range for Aurobindo Pharma. But again, I think I'll still stand by with what I mentioned in the morning also, that if you have to be bullish on the pharma pack, then I think there are far more better price performers as well as more stable leaders in the entire pharma sector in terms of price performance. So I will go with that. Maybe adding to the list of DV slab, Lupin, Sun Pharma, I think at 1650, 60 mark is also on the verge of a breakout. So you might have fresh additions there.
Okay, Kunal, thank you for that. We'll let you go on that note. Snehi is standing by, of course, with all that's happening at close.
Well, absolutely, Harsh. Thanks for that. Let's take a look at how the markets have panned out in today's trading session at close. Let's pull up the big tracking chart and let's take a look at what the Nifty is up to right now, because very healthy moves coming in on the Nifty, 0.5% higher, 125 points higher on the spot for the Nifty. So looking good on that front. Similar is the move coming in for Sensex today, another 0.5% uptick coming in, comfortably above that 82,000 mark, 82,100 also, in fact, looking comfortable right now. Advanced decline ratio quite even, Steven, and in fact, slightly in the favor of the declines, but other than that, the overall market trend has been very positive today, because take a look at the broader market moves also, right? Nifty mid cap is up about 1%, Nifty small cap also up 0.5%, and a small cap in line with the benchmarks, but mid cap big outperformance coming in from the entire mid cap basket. Nifty Bank too up 0.2%, slightly underperforming the benchmarks, but not much to worry about, because both private banks and PSU banks have been doing very well in today's trading session. Let's take a look at some top gainers and losers today. JSW Steel, Tata Steel, these are your two top sectoral gainers. Of course, the zing that we've seen on Nifty Metal today has been a very good one. This followed by some IT stocks like HCL Tech, that one did well, and this followed by SBI Life, Sun Pharma, Ultratech, BEL. So in fact, various sector participants in the top Nifty 50 list of gainers. On the flip side, only select handful, a couple of stocks in the red from the Nifty basket. Axis Bank, Titan, HDFC Bank and Tata Consumer. Tata Consumer, in fact, on the flat line. So really just 3 stocks that are losing from the Nifty 50 group of stocks. If you take a look at sectoral moves, like we mentioned, metal was this index that did very well, a 2% uptick, slightly more than that on an intraday basis. Names like Hindustan Copper, Hindustan Zinc, SAIL, NMDC, all of them have done well. This was followed by IT, and of course, all eyes are going to be on TCS. The earnings will be soon, will be out any time now, so very soon that. Nifty Pharma, also very good news coming in for Pharma because generics, there's clarification, are not included under tariffs. It's only specialty chemicals, so specialty drugs. So Nifty Pharma also doing very well. This followed by Realty, PSU Banks, Energy, FMCG, Auto, very surprisingly, which in the last 30 minutes or so of trade has made a jump towards the green, but it continued to be in the pressure all throughout, but very healthy move coming in on Nifty Auto as well. So that is how we're summing up for the day and wrapping this edition of Closing Trades with the Nifty about 0.4% uptick coming in over there, but above the 25,100 mark. With that, it's a wrap on Closing Trades. Thanks so much for tuning in.